Hi, good afternoon. My name is Rosa Franco. I'm very happy to be here today again. This is another week where we are implementing or developing the webinar in financial series, right? So the first week we spoke about credit, how to establish and why credit was important or is important. Then the second week we developed everything related to how to become eligible for a business loan and what were the differences between credit lines and term loans for small businesses and in what way Neighborhood Trust works offering these type of products for the small business community in New York. And last week, Nazareth, who also is helping or supporting this session, Nazareth Perez, she developed everything related about marketing strategies to help the small business community to improve their sales. So this week we are going to discuss, or I'm going to present some tips that are very important, or I hope will be very helpful for those who are looking to buy a property. So let's start. Again, my name is Rosa Franco, and I am the Director of Lending at Neighborhood Trust Federal Credit Union. Today we will cover the topics around kind of giving an overview of the situation in terms of home ownership. I will also, as usual, I'm going to present the mission and also what is involved when we are talking about home ownership and what will be the steps that are recommended to do or follow for those who are looking to apply for a homeowner or a mortgage loan. So let's start. If you see here, something that it was very something interesting, it was an interesting finding was to check what's the distribution of home ownership in the United States by age. And as you can see, we have that the highest percentage of ownership or home ownership is in the group of people whose age ranges between 55 years to 64 years old. And we can obviously see that the younger the population, the lowest the, let's say, the participation in home ownership. But if we go a little bit more in depth, we can see that the Hispanic community is one of the communities or groups by ethnicity that grew the most in terms of home ownership. However, if you see the fourth point, the communities of color are actually the ones who are most at risk of facing foreclosure. So one of the reasons why I'm presenting this information is because there may be many reasons why our communities, and I say our because Neighborhood Trust mainly serve communities of color, are struggling with this type of risk of foreclosure, but in many cases it's because the dream of getting a house, if it's not followed with proper preparation, can really become a nightmare. So what we want to do here is actually sharing the basic tips that you can follow to reduce the risk of facing any type of problems, and also to increase your chances to be loan ready by the time that you are looking or you are ready to get your property. So this goes aligned with our mission, which is to empower our community to become a productive participant in the financial system with the goal of achieving their financial goals, right? So There are three things that everybody will always recommend when you say that you want to become a homeowner. And one of the things that you will hear, or the advices, is that you have to focus in the location of your new property, or how much are you going to pay, and of course, what will be the size of the property that better fits to your needs or your family needs. But really, what's involved in the homeownership or preparation to become a homeowner is that we want to share that the property search is one part of the entire job or homework, but the financial preparation and how to be ready to closing the deal, meaning the time where you sign your contract with the lender that allows you to get the home, is what we really need to be focused on. So there are some considerations that are really important when we are talking of homeownership. And in many cases, our borrowers think that the mortgage only involves or includes the loan payment, when in fact, depending on the type of property that you are looking to get, you will have to consider additional costs. Like, for example, if you are looking for a property considered as real estate, or those houses that are for up to 4 family units. So then you have to consider that in addition to repaying the loan or mortgage loan, you will have to include the property taxes and the homeowner's insurance. So both, and if you are giving less than 20% of loan payment, also the PMI, which is an insurance for those who are giving less than 20% down. So all that will be included in your monthly cost with the mortgage payment. But if you're looking for a co-op apartment, your monthly loan payment will also have to include, or you will also have to consider, the monthly management fees. And if you don't want to get a real estate property, but at the same time, you don't want to have an apartment in a cooperative building, maybe a condominium will be an option. But in that case, you will also have to consider your property taxes plus the management fee that you have to cover on that association, and also the homeowner's insurance. So in other words, if you are renting now and your expense or your monthly payment is $1,500, what you need to consider is that you may or may not necessarily be affording that same amount, but you will really have to include these payments as part of your financial preparation. So, and that's the difference also, because when you become a homeowner, you also need to be in charge of any kind of repairs, renovations, utility bills, or you name it, that are necessary for you to stay in that property. So one of the first things that we want to recommend you to do is to check, as a first step, is review your personal finances, meaning, in fact, actually, how many people will participate in this mortgage? It will only be one person, or maybe, as we have some cases where the family members participate on that, meaning that all of them, 2-3 people of the family who are currently working or employed, may participate with their income, affording the monthly payments of the mortgage. So, for example, in that case, it's if we are talking of a family, it will be very important to have that discussion first, so you can all be preparing together with this goal, which is actually getting ready for to get your property. So once you decide or you identify how many people will participate on the mortgage, it's important then to start working in your credit. As we discussed during the week that we delivered the session around credit, the higher your credit report or your credit score, it will be the lower the risk, meaning that is going to impact in the interest rate that you will have to pay for that type of loan, for this type of loan. So in this case, we always recommend the borrowers to try to be with a FICO score over 680. Also, as part of this preparation, it is really important to make sure that you are managing your personal debts, meaning if you have credit cards, any type of personal loans, try to pay them off or reducing your balances as much as possible. And with that, basically the reason for that is because if you remember the previous, in this case, that you have to include property taxes plus homeowners insurance or monthly maintenance fee, that is going to be added to your monthly payments by the time that you are applying for the loan, meaning that just take into consideration that in our case as Neighborhood Trust, because we are more flexible, no more than 40% of your monthly gross income has to be allocated to cover all the mortgage expenses, as I already explained, plus your total minimum monthly payments. And all that combined cannot be more than 40% of your monthly gross income. So the following step then will be, or part of this reviewing of your personal finances will be to check what is your repayment capacity. So on that case, as I explained, it will be the borrower or the borrowers whose total income cannot be, or whose 40%, whose limit cannot be over 40% to be used in assuming or affording these monthly payments. Now, you can, if you're interested, you should contact or schedule an appointment with our financial counselor, because on that case, you will be able to review what's your status right now. And you will also get an action plan that will be prepared and tailored to your needs and your characteristics at this point, to make sure that you will have you will be able to create a deadline or a timeline. So you will be preparing yourself and all who will participate on this mortgage in getting these payments, these debts, and the credit score organized. And the following then, once you have followed all these recommendations, it will be also to check how much you have to put for the down payment. Even though it's true that there are many possibilities to get along with 3% down or 5% down as a down payment, you have to remember that the lower the down payment, it will imply a higher loan amount. Therefore, your monthly payment will be also much higher. So that's important because in our case, for now, we are still recommending or requesting 20% of down payment, which we understand that can be very high, but at the same time, in many cases, it really helps the borrower because the monthly payment is lower. So one of the considerations once you reviewed your personal finances and as part of your preparation, make sure that you have the down payment that is required by the financial institution. And also check how much do you have to cover the closing costs. I can tell you that Neighborhood Trust is one of the financial institutions whose closing costs are very low because we do not add any commission to the fees, right? That need to be considered when you are doing the closing costs. But what I can actually also say is that if you're looking to get a property, a real estate property, the property taxes that you will have to pay will have to be included as part of your closing costs. And in some cases, that can be very, very high. It depends and changes based on the county where you are looking to get the property also. And the last part of the consideration that you need to check is that you have the down payment, you have the funding to cover the closing costs, but you also need to have an emergency fund. Some lenders, will require you to have at least 6 months of equivalency, the equivalent of 6 months of monthly payments. We can be more flexible on that case, but you have to remember that this emergency fund is yours, but it also helps to cover any sort of, as it is, right, an emergency if by any chance you get sick or there is an additional problem at home that you need to cover. So your monthly expense or your monthly payments will not be affected. Why this is important? Because you don't want to be in the situation where your loan is in delinquency, and if it extends for too long, maybe you will be exposed to face a pre-foreclosure or legal actions or that kind of problems, right? So it's important to have an emergency fund, and it will be very unlikely that a lender will be willing to approve a loan if you basically, after putting the down payment and covering the closing costs, you end up with zero funds in your savings account. So that's really very, very important. Let me see. So the step 2, then, once you discuss with the financial counselor, you started saving gradually to get your monthly, your down payment and covering the closing costs. So the next step will be then, or simultaneously, start organizing all your documents. Meaning, do you have the tax returns? You need to make sure that you have the most recent 3 years of tax returns for you and those who will participate in the purchase or the mortgage. Same thing will be with the proof of income. And in that case, if you receive pay stubs, make sure that you have all your pay stubs from the last 2 years, just in case the lender will ask you to provide more information. If we're talking of self-employed people, for example, bank statements will be very helpful as long as you can demonstrate that you receive income on a monthly basis and is steady. I will never stop emphasizing this part of the request, because we have borrowers who, for example, are self-employed, or maybe they work in companies where they receive their payments in cash, right? So we understand that's part of the reality, but what we really need to see is that there is a consistent deposit on the account. And when I say consistent also, that means that what's deposited on the account is also reflected at the end of the year in the tax returns. So that way, everything matches, right? Also, for example, if we are talking of those cases where there is a contribution at home from family members that not necessarily will be participating in the loan, but they participate contributing, as I said, maybe giving some part of for the monthly expenses. So it's important to have that information also in the account. So whatever you have has to be really reflected and properly proven by you or those who are going to apply for the loan. In terms of proof of savings, this is basically for the cases where you need to demonstrate that you have the funds for the down payment and also to cover the closing costs. On that case, it's really critical for us to check that the funds were on the account during at least 6 months. Why this is necessary? It's necessary because we cannot, for example, accept, or we need to make sure that the borrower is not borrowing money to cover the down payment. Otherwise, that is going to be or can become a problem in the future when the borrower needs to repay that payment, when that loan that was borrowed to cover the down payment. So it will be not only the mortgage expense, but it will also have to include this extra fund or extra loan amount that has to be repaid to a third party, right? So we need to make sure that this information is there for at least, as I said, 6 months. Now, if you have other assets, it's important also to have proof of that. Do you own a car? Do you have a retirement plan? Do you own a second property? Whatever you have, make sure that you have everything organized in terms of documentation. The more assets you have, of course, it is going to look or make you look as stronger in terms of repayment capacity and financial strength, right? But if you don't have that, of course, it's not a case where you will be eliminated, or it's not going to be necessarily affecting the loan application per se. But if you have additional assets or income, please make sure that you have everything organized in your paperwork. So once you have your personal finances organized, you save for the down payment, you have the funding for you to cover the closing costs, or maybe you got, let's say, for example, a grant to cover closing costs, you have all your documents. This is the proper or the perfect time for you to start the process, meaning you can request a pre-qualification letter, meaning that you approach your lender. In this case, you can approach one of us and filling out the form to get the pre-qualification. It will basically allow you to know how much you can be pre-approved for. So basically, a pre-qualification or pre-approval letter is a document that states if the lender is willing to lend to you for up to certain loan amount. So usually, this letter that has a validity or expires between 45 to 60 days expires after 45 or 60 days of it being issued. This is the document that you will be asked to present when you go to open houses, because brokers and sellers will be more interested or inclined to show you the property and the facilities if they know that you at least have a chance to be the next buyer of that property, right? So you can download the pre-qualification letter. I've shown there the link. It's in our website, but you can download that and fill it out if you are interested in getting that. Remember that when you are getting a pre-qualification, in our case, there is no fee attached to it. We also pull, we make a soft pull, meaning that it's not going to affect your credit if you get that. And you also need to make sure that you are giving all the information as more accurate as possible, because there is no additional documentation required to be presented when you fill out a pre-qualification form. But that means that if you keep moving forward in the process, you will have to provide all the documents that are going to prove that the income that you said you had is real, that the assets that you said you had are also real, and also that the down payment or the amount that you offer to have as a down payment, which is part of the information you need to provide on that form, is actually accurate. So once you get the pre-qualification letter and you find a property that fits to your needs and is within the range of money that you are allowed or pre-approved for, you can make an offer, right? So once you make an offer, that means that you are telling the seller that you are interested in that property, that you also have the means or the funding to cover that expense. And it's at that point when you get into a sales agreement. That means that the seller will say, if you give me the initial deposit, I can guarantee you that I'm not going to offer this property to anybody else, but you need to make sure that within a certain period of time, you will be able to get the loan. So I will sell the property to you, right? So that's important, and it's very necessary for you to make sure that you have the pre-qualification form, that you have everything else ready and in place, because usually the seller is going to wait for no more than 2 or 3 months in order to make sure that you finalize the financing process, right, for this property or this transaction. If you do not comply with that, then it is very likely that you will lose part of the deposit you initially gave to the seller if the reason for the delay is on you and not on the seller side. So once you have the sales agreement signed by both parties, you provide the lender that sales agreement, the loan application, plus the documents required, right? Depending on the case, if we are talking of a real estate property or a co-op or a condo. And the lender will evaluate the information. So the next step from the lender side, once everything is been reviewed, is to start the appraisal on the property. The appraisal is basically a verification of the market value of the property as it's being requested by the seller. And that's really important for you as a buyer, because you can at that point make sure that, for example, you are paying the right price for a property that you were told that you will have to pay for. So let's say that the property's value is $200,000, but the seller requested $250,000. So that means that by one hand, your down payment will be much higher, right? If we are talking of 20% down, but also that means that in the short term, your investment is not as good as it should. So this appraisal also from the lender's perspective, it's important because we know how strong is your investment and our investment as well. So let's say that everything goes well, the market price that you've been asked for matches or is according to the appraised value as it's been obtained. So then we can move forward with the next step, which is making sure that that property is legally clean. So we start the legal due diligence, and that also includes the buyer. So we will run all the more in-depth evaluation, making sure that there are no tax liens, there are no pending obligations from the borrower or borrower's side. Why this is important? Because, for example, if the borrower has a tax lien or even, for example, judgments related to child support pending fees, that will, in some cases, that can affect or negatively affect the chances to continue with the transaction or the closing. In many cases, for example, it may be necessary to request the borrower to pay off all those pending balances in order to be able to start this next transaction. So if everything is clean, the property doesn't have any pending violations, if the property doesn't have any additional liens, meaning that there are some other obligations that you were not aware of, and also the buyer personal information and everything is clean. So we are basically ready to go to move to the next step, which is basically scheduling the closing. So all this process can be as short or as long, depending on how clean or how ready the buyer information is, and also the property's information is as well. I think this is like a basic overview, right? In terms of let's say buying or getting a property. But also, for example, part of what I think will be important to mention today is that in the same way that you need to provide info related to the borrower, let me show you that depending on the case or the type of property that you are looking for or you will be interested in to acquire, it's going to be also the type of documents that you will need to provide related to the properties itself. So if we are talking about condos or also co-ops, keep in mind that the condo and also the co-op will need to provide information related to the personal finances of that association. So for example, for the co-op apartments, in addition to your personal information, we will require to get details to make sure that the co-op, the cooperative, manages the finances in a good way. So that means that, for example, there are no pending liens, that they don't have any losses. Why this is important? Because we will make sure that your investment is going to be safe, because we are also assuming the risk of investing in that building. So I think for now, I'm going to leave it here. And I want to see if there are any questions that I can, what are the closing costs? Okay, so on that case, there is something that is really important to mention, and it depends on the type of property that you are looking for. So for example, overall, the only upfront fee for for a mortgage, in our case, is the only upfront fee is the appraisal fee. So, for example, it usually the price ranges between $425 to $550. This year it's been very unusual because we have, like, for example, the appraiser companies are very busy. So that means that it's really difficult to calculate and also to find appraisers that will be available to perform the evaluation, right? Now, remember that by one hand, you have the upfront fee that will be the appraisal. I mentioned what's the range, but also it will be an origination fee that it depends on the loan amount that you are looking for. So, for example, in our case, the origination fee is 1% of the loan amount. So we are basically talking of that range. Now, in terms of the additional fees, I can, let me show you one website. You can, I'm going to find, so I will share with you the file or the website where you can do a kind of calculation depending on the type of property you will be interested in getting. Like, for example, thank you, Nazareth. So basically, for a 200,000 loan in a co-op apartment, let's say the closing costs will be between $3,000 to $4,000. If we are talking of a real estate property, the fee or the closing cost is going to be higher because you have to include the title insurance as well as the taxes or property taxes that need to be paid for that transaction. The same thing is going to happen if we are talking of a condo, right? So in terms of closing costs, probably I can tell that the cost is going to be lower if we are talking of a co-op apartment or mortgage for a co-op apartment. But let me, while you share another question, let me find the website for that. We have any other question? Yes, if you haven't used your 401k, there is a limit. You will need to contact the company, but yeah, in general terms, you can use your 401k to cover down payment with no penalties, depending, of course, of I usually try to avoid to give definite answers because sometimes there can be something additional that may need to be taken into consideration, right? But yeah, usually you can take part of your 401k retirement savings. So if I think, let me just check. if the apartment of home needs repairs. So for example, in that case, it depends on what's the equity that the apartment has, like meaning, for example, let's say that the purchase price is, I don't know, $100,000, right? And the borrower provided, let's say, $20,000. Like in our case, we request 20% as a down payment, right? But the repairs will be $50,000 worth. So I think on that case, it's going to be difficult, but it depends on what's the range that we are talking about. It cannot be like, for example, if, as I said, if the property price is as high as 100,000 and is inhabitable, so then it is very unlikely that the appraisal actually is going to give or reflect a positive number. So what will be the conditions of that apartment? It will be something to consider. But if the lowest down payment in our case is 20% for now. The reason for that is because we are not yet, we are not similar to the FHA. So our regulator, for us to be in compliance, we have to request 20% down to reduce the risk of the investment. Because in that case, please remember that it's a shared risk where the lender is assuming 80% of the risk of that purchase. So that's the reason why for now we are basically accepting the minimum of 20% down. Also, if you give less than 20% with any other lender, keep in mind that you will have to pay actually a monthly insurance payment in addition to your mortgage amount. Why is that? Because there is a risk associated to the transaction for the fact of being giving less than 20% to initial deposit, for the initial deposit. I'm trying to find the name of let me check. Let's check one more thing. This is the link I wanted to show you related to how to check the, just share. I will share very briefly my screen. Here we go. So this is the one of the title companies that you can check, where you can check the closing fees. And if you come here to the rate calculator, you basically need to fill part of the information. Like let's say we are talking of mortgage, right? In a regular property, which loan amount is $200,000 for a one to two-family property, and the municipality is New York. So you can find here that there are different, if we are talking of New York, you will find different counties, right? So if you press to calculate, for a real property, this will be the estimated cost, not including, on this case, the appraisal and the legal fees that the lender will ask you to cover. So in this case, if you notice the mortgage tax, it's actually the highest it takes the highest amount out of that total fee, or the total estimated closing cost. So I'm going to give you the link, but it's basically to give you an idea, right? And so let's say that we are talking of co-op or condo residential. You calculate that for a condo, it will be $6,000. So you see that there are different fees associated to the transaction. And let me see if we can find. So for a co-op, what you will need to eliminate will be the mortgage taxes, because those taxes will be absorbed by the co-op. So that's the reason why I initially mentioned that the closing will be lower depending on the type of property. So we don't have yet a first-time homebuyer program, but you can check, and you can check there are different organizations, nonprofit organizations that offer that, and you can use those funds to cover the closing fees or the closing costs. And also there are some other organizations that issue, for example, the grants, so you can complete the down payment or even increase your down payment. We will try to find that information. So there you go. Let me just see and share the. Let me just do this. So here is the so this is the link to review what the potential or tentative closing costs will be. Again, that this does not include legal fees and origination. And also we are going to update on a monthly basis with those who will be interested in working at some point with with our homeownership program. We are preparing some surprises, but we cannot really give a specific date. So if you are interested in getting more updates about our homeownership program, we will share a link where you can enroll yourself, and you will get informed about the different changes and different options we will offer soon for those who are interested in become homeowners soon. Okay. So Nazareth, are we going to share the link to enroll, or you already?
Yeah, I provided the information on there. If someone is still not yet receiving our newsletter, to send me an email so that way we could add them on there. And then we're gonna create a form that particular for home ownership moving forward. So
Excellent.
I'm gonna provide my email again on the chat, And then feel free to email me directly if you have any additional questions in regards to home ownership.
Fantastic. So this is basically it for today. I'm totally sure that we will develop a second session soon. Please contact Nazareth if you are interested in getting more information about homeownership, but also if you feel that you are at the point where you can get a pre-qualification letter, so we can start the work. If you don't feel that your credit is in the best shape possible, also let us know. We actually have experience working with borrowers that for some situation, maybe their credit fall down, but we help them to be loan ready. So by the time that we get the entire process done, their credit is in better shape. So the interest rate that they get is actually also very affordable and helpful, okay? So thank you again for participating today with us, for joining us, and we will stay in communication soon. Thank you. Have a very nice day.